find the answer to that. Because once somebody has found an answer to that question, everything else starts to become really clear. Tony says, where focus goes, energy flows. It's so true. The mind will find what it's looking for, and you just have to set your mind on what it is that you believe. And again, you can always reroute and reposition. But if you don't aim for anything, you will absolutely hit nothing.
Christopher Zook is the founder, chairman, and chief investment officer of CAS Investments, a $10 billion plus asset manager.
So, we're $11 billion now. We are nowhere close to what we can be. Ultimately, he became an investor in one of our funds, and that led to a conversation, which led to another conversation, which then in 2021, he actually became a shareholder of the firm. And then we wrote the book together last year, The Holy Grail of Investing. And people asked me at the time, is this a surreal moment to where, here's somebody that you have literally followed his teachings for so long, and now you're actually on a stage and you're writing books together.
Christopher recently co-authored The Holy Grail of Investing with Tony Robbins, which became a #1 New York Times bestseller.
Hello, everyone, and welcome to the Holy Grail of Investing podcast with Tony Robbins and Christopher Zook. We're thrilled that you've tuned in because over the next couple of sessions, we're going to talk about some of the most interesting things in all of the world of investing. A better business model on the planet than managing a private asset management fund. The same to think we're only going to allow to go into a government bond. Some things that will really be valuable to you as you go about your businesses and your investing.
$5 trillion of GDP a year is China and the United States. That's it. One company was worth more than the entire output.
Christopher was honored with the Texas Alternative Investments Association's Lifetime Achievement Award in recognition of his contribution and sustained support of the industry in Texas.
And the thing about almost all people is they can do a lot more than they think they can. And they just need to be given the opportunity in their own mind and then create the opportunity in their world to go achieve what they're truly capable of. Most people can do anything they want if they set their mind to it.
My guest today is a great example of how increased self-awareness, clear, actionable, and measurable goals, an unwavering commitment, and a strong sense of purpose can take you places beyond your wildest dreams, one small step at a time.
Christopher Zook is the founder of CAS Investments, a firm he built with a long-term view of capital, people, and partnership. In this conversation, we talk about clarity, about goal setting, about reshaping your mindset, about the future of the alternative asset space, about the tension between the size of your goals and your fears. We talk about football and, of course, about Tony Robbins. This conversation is about business, but it's very much also a conversation about life, and I'm grateful to share it with you today. But before we begin, I want to remind you as you watch or listen to this, please bear in mind that The Bigger Why is an independent podcast in which I explore topics that are meaningful to me in my own personal capacity. The Bigger Why is not sponsored by or affiliated with any company or other outside interests. So to be clear, any statements or opinions expressed by me or any guests on the show are made in their personal capacities only at the time in which they made them. Please also bear in mind that this discussion is for informational and entertainment purposes only. It is absolutely not legal, financial, or investment advice.
I would also recommend that you consult with your own advisors, do your own independent research, and arrive at your own conclusions on any of the topics we discussed today. After all, helping you formulate your own worldview is kind of what this show's about anyway.
Sure. No, happy to do so. Thank you for having me. I appreciate it. Grew up here in Houston, Texas, where we're filming this today, and always, really was an athlete as my primary focus. And then when I went to school, played football. I had to stop playing football because of a second knee injury, and took up the game of golf. Was able to be successful enough to make the golf team there at Texas Tech, and then started the investment business straight out of school. So from that point, worked in various roles in the investment world until I started the firm in 2001. And so next year actually will be our 25th anniversary which is kind of wild to think about. It's already been 25 years, but we're just getting started.
When you're having fun, it goes by quick.
Yeah, it does. It's exactly right.
So what sort of led you to, I want to start my own firm? I mean, obviously the investment space can be, especially if you're starting, 2001, you need a big bite to chew.
No, it was. And the good news is I didn't have to worry about what was happening in the world at that time because I already had my specific goal and my specific target of what I wanted to achieve. But you have to go back 10 years prior to that to know how that was generated. So in 1991, literally first year out of school, was successful early on, but was really driven to do much more than that. And so in December, I can actually visualize where I was at the time. I got home late from the office, which is pretty typical. My wife had already gone to bed, and I was making myself some dinner real quickly and was watching TV. And I saw this guy on TV that was a huge individual with big hair and very big teeth, otherwise known as Tony Robbins. And, I liked a lot of what I heard. And so I ordered the tape series back in that day. Yes, a cassette tape series. They couldn't stream on demand then. Yeah, but this is, a lot of people I tell that are younger, they're like, what the heck is a cassette tape? Cassette tapes, you actually put it into a cassette player and you listen to it. And no video to go with it either. It was all audio. But Lisa and I, it was a 30-day course. And so Lisa, my wife, and I, we did that 30-day course. And one of the days you actually set your goals for what do you want to achieve that year, and basically design your life, and to an extent.
Right.
Well, one of the specific targets that I set is that within 10 years, I wanted to start a firm by the name of Kaz Investments. And every step along the way for the rest of my career up to that point, for the next 9 years and 9 months, was to help me start this firm. And so naturally, it's not an accident that 9 years and 9 months later, we opened the doors of Kaz Investments because of the fact that that decision was made and then every action was taken along the path to achieve that particular outcome.
How serious were you in your mind when you set that goal 10 years out? Was it pipe dream?
Serious as a heart attack is the best way to put it.
Wow.
So one of the things that Tony teaches, which I'm very thankful for and appreciative of, is if you don't have a major why and you don't have, a reason of why something is a must, as opposed to, and I'll quote him, he says, you got to be really careful not to should all over yourselves, right? You can't say, I should do this, I should do that, etc. I will do this and I will do that. And that mindset and that shift of this is not something that's optional, this is something I will do, is very, very different than most people when they go through their goal setting workshop in January and then or in late December. And then by the 1st of February, like, that's too hard. I'm not going to do that. There was never a question that I was going to do it. The only question was, what was the best way to go about doing it? What skills did I need to have? Who did I need to know? What experiences did I need to experience in order to prepare me for what certainly was a daunting and unknown task of what that was going to look like? But at the same time, and I'm very strong in my faith, and I try to be at least, but as a Christian, I felt like that was what, when I prayed over it, that's what God wanted me to do. And if God is telling me to do that, who am I to second guess that? My job is just to be faithful and to do what he's asked me to do and to give it 100%, and he'll take care of the rest.
So the way goal setting is kind of the crucial point, because you could shoot yourself too short by putting up a goal that's easy, but then if you go too long dated or too extreme or not delineated, then you may wind up.
I mean, I teach a lot of material on goal setting, most of which I've learned from Tony, and some of which I've adapted to other experiences that I've had and other things that I've read and learned. But almost every single person who teaches goal setting is going to teach a SMART goal. It must be specific, it must be measurable, it must be achievable, it must be realistic, and it must be time sensitive, timely. So, it's not a realistic goal to say, okay, I want to lose 100 pounds. I mean, I'm 180 pounds. The only way I could do that, there is a way.
Yeah.
I could cut off both legs and I would achieve that. I do not wish to do that. So the only way for me to achieve my goal in a realistic fashion is to set something that is a realistic, and I can map out a way to get from point A to point B by a certain date and then work backwards as to how to do it. And I knew at that time I needed to have certain knowledge in legal and compliance and regulatory and accounting, which I really didn't want to learn, but I needed to learn, right? There's some people out there that love accounting. I love that about you. That's not me. I work with it because I have to. Same thing with other aspects of business. You just have to know it if you're going to have your own firm. And it's amazing how many people think, I want to do that. They try it and they're like, okay, I really didn't like 90% of what I do every day. I'm going to go back inside of another business and let somebody else do all those other things. And that's totally fine. There's a lot of people that think the magic bullet is to be able to go start your own firm. And that may be true for some people. For most people, it's to be, a real business within the business in which they operate. That was true for me when I worked at the firms I was at before, but then ultimately now running the firm. And obviously I made so many mistakes along the way that it's just something to where most people don't want to persevere through all those mistakes that I had to persevere through in order to continue to get to 25 years.
So it sounds like the commitment was integral to you continuing to persevere, because since then the commitment was so firm, regardless of the obstacles, you really had to figure out a way.
That's exactly right. It's a little corny to say it this way, but it's true. But the bigger the why, the harder we try. We've all heard stories of, little people, a lady who's 5 foot, 120 pounds, but she can lift a car off of her child. Why? She got a huge why. She's going to find a way, and it may not be within herself at all in her mind to be able to accomplish that. There are all kinds of stories of people overcoming enormous obstacles because they're motivated so much by the why. There's the saying, again, borrowing from Tony a lot here, but it's hard to push somebody to a target. Okay. It is much easier if that person is pulled to that target. They're so drawn to it. They just want to become that. It's who they are. They just aren't there yet. That is ultimately what allows somebody to achieve what they want to achieve, to get up early, to stay up late, to work harder, to do things they didn't think were possible because they have such a motivation. And the problem is for so many people is they're like, I don't really know what my why is. And it's hard to find. I mean, it's not like, hey, let me just create my why today. It's got to be something that somebody, depending on their faith, they pray over it, they feel led to it, or something that they're just impassioned by, that they just really set their mind to achieve it. And by the way, it's totally fine if somebody changes a target along the way, as long as they do it for the right reasons and they have a good why as to why they're doing that. What somebody thinks when they're 21 years old, like I was, that is my 10-year goal. It would have been fine if I moved it, as long as I didn't do it because I'm giving up on that dream or whatever. But because of the fact that I feel called and pulled in another direction, that's okay. The key is, this is what I tell young people all the time. Go away, go to a hotel room if you have to, or go, hike, bike, camp out, whatever it may be. Spend time just in nature, spend time by yourself and just think about, okay, rocking chair test. If I'm in my rocking chair and I'm 105 years old looking back on my life, what is it that I want to make sure that I actually have achieved and accomplished that I will be proud of? Not that other people are going to be proud of me for doing, but that I'm going to be very proud of for doing. And sometimes people still come up blank, and that's okay, but don't give up on it. Figure out what that looks like, and at the same time, bloom where we're planted, and to be excellent at whatever we're doing right now, because if we're excellent at what we're doing now, wherever that may be, doors will open for us to be able to do other things if that's something that we want to have happen.
Oh, were you born this way, or was this demeanor kind of?
It's funny. I mean, I had a very kind of challenged, upbringing that I've been open about before, but my father was an alcoholic. My folks got divorced when I was 13. To be very clear, there's people that had a lot worse backgrounds than me. So I'm well aware of many of those stories of people that were abused and other things. I was not that, but I had to grow up very early in life, and I became effectively an adult when I was 14 years old, and I was the man of the house. I started working when I was 12. I've always worked. I've always been driven to accomplish things that I felt were really, really important. And in many cases, were driven to become something that was overcoming the challenges that I had when I was younger. But at the same time, I do believe that just the good things that my father taught me before he had his challenges and before he left the home was, hard work, discipline will pay off. And there's no question that one of the best lessons that I got from my father was that, there's no room for mediocrity. You either do it right or you don't do it at all. And I may not have appreciated at the time the way he explained that to me, but it's a lesson that I'm very grateful for, as challenged as obviously that situation was, because before he had his issues, I was able to learn a lot. That was very important to who I became as an individual, but I really didn't have this much transparency and visibility to our focus, if you want to call it that, until such time as I had a big enough why, which was, I know what I want to accomplish. I know what I want to achieve for, my wife. We got married when I was 20 years old. She was 22. So, I know what I wanted to achieve for her. I know what I would achieve for my future family, and ultimately what I want to be able to do to be impactful, for my faith and to be able to be impactful on the world. So all of that combined, along with a pretty intense personality, kind of translates to, you know, a real focus on let's see what we can accomplish and not let anybody tell me I can't do something. And then you add on top of that Tony's, material and teachings and things I've learned from Tony over the last, it's hard to believe, but literally 35 years now, to be able to refine that focus and then to achieve things that I never thought possible. Something I'm very grateful for. And I'm very, I don't want to lose it.
Yeah, it's precious, and it is something that is a rare commodity. So do you impart this and integrate it into the firm in the way you guys manage or you guys do?
We do, probably to an extent that some of our team gets tired of hearing about it and listening to it. But for those that don't know the story, which is I'm sure most of the audience, from 1991, when I first was introduced to Tony's work, I never went to a live event actually until 2013. And it was at Day with Destiny in 2013 that I really was able to overcome some of my own personal constraints. And then I went to Business Mastery in February of 14, and we really totally redesigned the business. The business was doing fine at the time, but I wasn't satisfied with fine. I wanted to do a lot more. But so Tony actually became an investor with us in 2017, and I had nothing to do with it. I didn't know anything about it. He was referred to us by someone, and ultimately he became an investor in one of our funds. And that led to a conversation, which led to another conversation, which then in 2021, he actually became a shareholder of the firm. And then we wrote the book together last year, The Holy Grail of Investing. And people asked me at the time, is this a surreal moment to where, here's somebody that you have literally followed his teachings for so long, and now you're actually on a stage and you're writing books together. And I said, yeah, no, it's a very much like, you can't make this stuff up.
Oh, that's it. You can't make that.
And so the back to your question, for literally the first, whatever that works out to be, 20 years of the firm before he became a shareholder, I mean, everybody knows that, Tonyisms are going to be a reality of Christopher's language. So there's two things that everybody in this firm will tell you is that we talk about Tony and his teachings, then we talk about football, right? I played football in college. I coached high school football here in Texas for 4 years. Everything to me is a football analogy or something that Tony has taught me. And obviously there's some exceptions to that. But, for us, it's about our faith. We're very open about our faith, and we have all faiths here at the firm, people that have no faith here in the firm. And I respect their freedom to do that. Whatever they want to be, that's what we want them to become. But we're very open about our faith. Then from there, we're all about, our families, and our families matter a great deal. And it's a challenge. I mean, it's a real challenge, especially for people with young children, just like it was for me, to where you're working your tail off. And we have one of our promises, which is, we'll exhibit a higher standard of work ethic. Well, higher standard of work ethic and also being a great, wife or husband or father or mother or daughter or sister or whatever it may be a friend, it's tough. But at the same time, it goes back to the why. If we want to be something totally special, you don't get what everybody else wants by doing what everybody else does. You have to be better than that. You have to work harder than that. You have to work smarter than that, etc. And so literally everything that we do and our entire ethos as a firm is about, this is about much more than just ourselves. We are a family here. And to be clear, families fight and we fight plenty, but we come together as a unified front so that when we go out to the world, we are truly that all for one for all. And we are that team that's going to go out and we're going to take the field and we're going to win. But every single thing that we do, every staff meeting, every quarterly review, every annual review that we do is centered around a lot of these ethos.
So using the football analogy, where is the firm and the industry in terms of yard lines? Are we on the 10 or the right line?
It's interesting because at first I started to say that the firm and the industry would be on two different parts of the field. I'm not sure that's actually true as I think about it. So one of the things that we've been very fortunate to be able to do is to see the opportunity set in alternatives investing, maybe a little bit earlier than some, certainly later than others, but we really embraced it. So in 2014, we really went, to use Tony's quote, we burned the boats. We went all in effectively on alternatives. And we believe that's where the future of the markets were going to be for firms like ours. There's still many great firms out there that do traditional asset management like we did in addition to alts, but we also saw fee compression coming, the real hard way, how hard is it to add alpha, in large cap, long only? We had a really good track record, but you're starting to measure it in, tens of basis points to hundreds of basis points. We wanted to add a lot of alpha and a lot of value to people. That is what took us to alternatives. So, we're $11 billion now. We are nowhere close to what we can be. And so I won't want to say we're on the 10-yard line in our own territory, but we're probably on 30 or 40. But certainly we're nowhere close to 100 billion or 200 billion or 300 billion, nor do we necessarily want to be that if that causes performance to degrade. One of the things that we talk about all the time is that bigger does not make better. Better makes better. And we want to be the right size to be able to use our scale to benefit our investors and all of our network, our global network of investors that we have. We have, 8,200 investors in all 50 states and 42 countries. Well, that scale gives us a lot of benefits. But if we had $2 trillion, okay, that scale is awesome, but you're really just not going to have a lot of ability to add alpha.
Probably it's a strategy draft or you're overreaching on stocks.
That's correct. And so we always tell people that if we ever get too big, we'll stop taking money. And I literally said this to somebody a couple of days ago in one of our strategies. If you don't get in, you're going to miss this because we're going to close it. Because a lot of things that really, I think, help us in that regard that are different than some firms is we have $650 million of our own money collectively as our shareholders, our team, and my family in our own funds. So we're the largest investor in everything we do. Well, because of that, we really don't want to have underperformance because of just excess capital. So we have done it many times over the last 25 years where we will shut down a strategy and stop taking new money. Or if the opportunity is gone, we'll shut it down entirely and give everybody their money back. Because that is what we refer to as just being freakish about alignment. And making sure that we're all about the performance of our vehicles, not just whatever somebody really wants to do. And particularly for investment advisors, that use us for their clients, they invest their capital of their clients with us. It is something to where we want them to always know with CAS that we are going to give them the very best that we can to deliver the best performance. We're not just going to give you a blue suit because you want a blue suit. If we think a blue suit looks good on you, that's what we're going to put on you. But otherwise, we're going to give you what we believe is best for our personal capital and then open it up to the entire network. That is a differentiator for us that I'll tell you, our investors and advisors, they love working with us because it doesn't mean we're going to be right. Okay, everybody's going to make mistakes and everybody's going to be wrong. But we've been fortunate that over the last 25 years, we have made money or have an unrealized gain on 95% of all the investments we've made in the private markets. So we're really good from a batting average standpoint. People have made more money than us, but we're really focused on not losing money. and being sure that we are aligned with our personal capital with theirs. And you add all that together, you get a lot of consistency and persistency, which is to me the most important thing an investor should look for.
Actually, it relates to what you were saying before, but you'd rather have someone be pulled. So allow me creates that pull versus.
Totally agree with you. Totally agree with you. And when somebody hears that, we're the largest investor and we're going to make the investment whether you invest with us or not, they're like, well, maybe I want to be involved or maybe I don't. That's up to them to make a decision what's best for their clients or for themselves. But ultimately, they know the only reason we're doing it is because we really believe in it.
Yeah. And so maybe with the retailization or more coming into the mainstream of alternatives, quote unquote, maybe if you can sort of give a high level overview of the alternative space, because it's interesting. We in the investing world think of them as alternative relative to traditional investing, but to many people, stocks and bonds are just as alternative. It's an investment. If you're not familiar with the lingo, maybe it sounds complicated, maybe it sounds like it's over your head, but I think most of this stuff is pretty common sense. It's a one you just kind of.
Sure, happy to do that. And I'm also going to go back and do what I should have done earlier, which was answer the rest of your question. So I gave you an idea of where the firm is, and what your second question is ties a lot to where the industry is. The democratization of alternative investments is a real thing. And so I would also say that the industry is on the 30 or 40 yard line. We're just now getting to where, there's more mass adoption, and technology is making this easier for this to occur, but to where people are able to invest in things they've never been able to invest in before. With the SEC rule changes that we saw in June, now every single investor can invest in a registered fund and has private investments in it at literally a $2,500 minimum with no accreditation requirements. That didn't exist literally 5 months ago. So there's an enormous part of the world that now can invest in things that they could never have invested in before, with us or with somebody else. But ultimately, that means you're going to see a lot more money flow from high net worth individuals. There's a couple of studies out there, but the average institutional investor has about 20% of their portfolio in alternatives. The average high net worth investor, meaning large, qualified purchaser, has less than 3. So getting is not necessarily going to go from 3 to 20. But when you talk about the democratization as a whole, and then you add 401k plans to the equation, you can just see this enormous wall of potential capital coming to the industry. That's why I'd say it's the 30 to 40 yard line. But for everybody who thinks alternatives are complicated, this is the way I try to explain it to them. They can be, but only if somebody makes it to be. The two analogies that I use, one that almost everybody gets immediately, is if you ever have owned a home, you own an alternative investment. It does not list and price every day in the Wall Street Journal. You cannot buy and sell it literally within 24 hours or in 2 seconds in the case of some things. You don't know for sure what it's worth. You think you know what it's worth, but you don't know for sure what it's worth until you sell it. That is also true for a buyout fund. It's true for a real estate investment fund. It's true for a venture capital fund. It's true for SpaceX. It's true for OpenAI, ChatGPT. The other analogy that people have to fully appreciate is the farmer analogy. And most people never think about the business model of a farmer. What is the business model? It's actually really simple. You buy a piece of dirt, or you lease a piece of dirt, you plant stuff, you cultivate that stuff, and then you harvest. And then you do it again. Now, obviously, it's a lot more complicated than that to actually do that, but that is the business model.
Right.
It's simple, doesn't make it easy. But that is exactly what it is when you're buying a company that's got $20 million of earnings, and you're going to go out and you're going to grow that company by either just getting new customers or actually by buying other companies that are similar and putting it all together. And now all of a sudden you've gone from 20 million of earnings to $100 million of earnings. Well, obviously, if you go from 20 to 100 million, you're probably worth more than the 20 million when you bought it. So that's how you make money in the world of private equity. That's growth capital, or it could be LBO, leverage buyout, fancy terms that the industry overuses when it's really not that complicated. I'm going to buy a business at 20. I'm going to grow it to 100. I'm going to sell it. That sounds like a farmer.
Right.
Again, it's much harder to do than it sounds, but that is the business model. Don't overcomplicate it. But at the same time, to everybody in the audience, if you don't understand it, don't do it. Because that is the problem that most people get into, is they invest in what they can, not what they should do. So again, don't shit all over yourself. So if you should, do something that is much more important, but you got to have an idea of I should do this, I should do that. How are you going to actually accomplish that? You have to go through the process of finding a partner who really knows what they're doing and that you understand why they're doing what they're doing and that they're aligned with you. And then once you accomplish that, then let the opportunities take care of themselves and trust your partner and be a good partner to them. You're going to be able to perform much better than you would if you were in literally just plain vanilla. Here's a fun stat. Most people would never appreciate this. 35 years ago, if you put $1 million into the global stock market, today, roughly, you'd have about $13 million. That's a lot. 1 million to 13, that's really good. It's about an 8.5% compounded annual growth rate. But if you put that same $1 million into the global private equity market, so public equity, something you trade every day. Private equity, there is no listed market for it. It just doesn't trade every day. That same exact $1 million would have grown by 15.7%. That equates to $293 million from $1 million. I don't know about you, but I like 293 million a lot more like 13 million. That's the difference of the power of compounding over a long period of time. Now, obviously, you shouldn't put all of your money into private equity, nor should you put all of your money into public equity. You should have a diversified portfolio, but that is where alternatives really comes in because, when we own a piece of the Houston Astros like we do, or the Los Angeles Dodgers, World Series champions again, their success or failure is not really tied to what happens in the market or what happened in the economy.
So we call it non-correlate.
That's correct. And, for all the people in the audience that think that's a complicated term, it really is. Again, we make things more complicated in the industry than we need to. But non-correlated just means they don't zig and zag at the same time. If you have a golf shop and all you sell is rain gear, there's going to be some days you're going to sell a lot of rain gear and some days you're going to sell nothing. But instead, if you have rain gear and you have sunscreen and you sell both of those, then sunny days you're going to sell a lot of sunscreen. Obviously, rain gear, you're going to sell only on rainy days. So mostly on rainy days. So the two together are negatively correlated. They make money at different times. Well, the whole point of the Holy Grail of Investing book that we wrote, and Ray Dalio is famous for that term, but for those in the industry, Howard Markowitz made this famous with modern portfolio theory. The key is to finding less correlated asset classes to where something is zigging and something is zagging at different times. But it's really hard to do in the public markets. It's funny, I had a conversation with somebody about probably 2 months ago, and they literally said to me, Christopher, I'm totally diversified. I own all 7 of the Magnificent Seven. Okay, well, let me just kind of clue that person in, which I did very gently, is that, okay, that means in a year like 2022, you're talking about being down 50% at one time because they pretty much move together. They do have some, variation, and one is going to outperform the other, but all 7 are pretty much going down at the same time or up at the same time. You want things that are not all moving in the same direction. And what we refer to is you want to get off of this volatile roller coaster and you want a much smoother ride, but you don't have to give up return. That's why Markowitz won the Nobel Prize, because of the fact that he proved that you can actually increase your return and reduce your risk at the same time, which everybody thought was impossible.
Yeah, we talk about risk-adjusted returns, which is what everyone is really looking to underwrite.
That's right.
And then when you're thinking about growth in the industry, maybe just so people don't think it's like, sales pitchy. Obviously there's growth, but there's also growing at the right rate. It's a stable way. Maybe some of the risks, if you speak of some of the risks where, in the public markets, there are some protections, disclosures, quarterly reports versus the private markets where you have a little less insight into what's happening. So it becomes really, you're diligencing the manager, but it's a bit difficult to actually diligence the underlying portfolio investments because you don't know what investments are going to also make.
No, it's very true. And that's why who your partner is the most important thing, because of the fact that you need to know that they are aligned with you and that they are obviously doing things the right way. We have another promise as a firm, do the right thing at the right time in the right way. Well, that's true also what you should expect from anybody you invest with. If they're opaque and not willing to tell you what you own, You need to have a real serious conversation with them about getting more transparency. If you're not sure how the returns are being generated, what it is that protects you as an investor, how you get out of your investment, when you can get out of your investment, you may not like the answer, but you got to at least know what it is in order to make a good decision. And at the same time, what investors make a lot of mistakes on is they just assume that they shouldn't do something because of the fact that it's something they're not familiar with. Another saying we have as a firm is we don't ever say no to something until we know what we're saying no to. And at the same time, we're going to be the fastest no in the West. Because once we know what it is, we're going to make a quick decision. Are we going to be involved? Are we not going to be involved? And if we think we might, we're going to do a lot of work and we're going to be really sure that we've done our diligence. But if we're not going to be involved, nobody likes a slow maybe. Just turn loose, let them find, other opportunities for themselves. But in this industry, because you're dealing with private markets, you're not going to necessarily have the same visibility as you would just, buying and selling Apple stock. But you're going to, in some ways, have even more transparency as to where the returns are coming from, et cetera, et cetera. The great thing about Apple stock is you always know every day, did I make money or lose money because the stock went up or the stock went down? But that has nothing to do with the business, right? You have to really understand and dive deep into 10Qs and 10Ks and quarterly reports to be able to say what caused this business to do better or to do worse. Well, the challenge is that in the short run, quote Mr. Buffett, the market is a voting machine. In the long run, it's a weighing machine, because if they continue to perform really, really well, eventually the stock is going to reflect that. In the private markets, it's much more correlated. To use that term again, it's much more tied to it. If I've grown that hypothetical business from $20 million to $100 million in EBITDA, in earnings, then what that is going to translate to is I'm going to be really confident on a range of what I could sell it for. Just like your house, I can't tell you exactly because I got to go through the negotiation process, but I'm not going to sell it for 100 million, likely, and I'm certainly not going to sell it for 2 trillion.
Because there's also certain adopted norms and valuation methodologies used by the market. So you kind of know what other people are going to value it based on those methodologies.
That's right. And that's one of the advantages in the private markets, for sure, is that you don't have to worry about this emotional roller coaster that, fear and greed that causes public market investors to completely bail out of something for no good reason, or completely to pile into something for no good reason. That volatility can still occur to an extent in the private markets, but it's much more muted because of the fact that it's not traded every day and you don't have hundreds of thousands of shareholders voting every day what to do and not do. In this particular case, it's a much more refined and less volatile way to invest. There may still be changes going on underneath the surface, and there always are, but your quarterly valuation is not going to dramatically change unless something has really dramatically happened in the business. They got a massive contract and they're going to make a ton more money than they used to. Yeah, it just went up a lot. Or they lost a major contract and, they may not be able to pay their bills. Well, it's going to lose a lot. But those are really pretty rare. And again, it depends on the sector. If you're talking about venture, it's, more of a binary outcome. If you're talking about, infrastructure, is that particular hydropower plant going to, change much? No, not really. Or that toll road? Probably not much. There's lots of things in this world that don't have that kind of business volatility, which means their prices are not going to change that much either, which is why investors need to understand what they're investing in so they see what the benefits are and they can see how it fits in the overall portfolio. And that's why having the right partner is the most important thing.
And if you could speak maybe to where the money is going, I don't think most people fully appreciate the actual contribution of private markets to growth in major areas, infrastructure obviously being one, but even things like defense, AI, and then maybe private credit as well, if you speak to some of those asset classes.
Sure. And I'll use one statistic to set the table for it because this really helps people understand the size of the private markets relative to the public markets. So in the United States, 85%, of the companies that do more than 100 million in revenue, so these are good-sized companies, are private. Only 15% of them are public. So everybody knows the NVIDIAs and the Apples and the Amazons and the Googles, et cetera, Microsofts. They're massive companies and they're fantastic businesses. But at the same time, the vast majority of our economy is in the private markets. So if somebody only invests in the public markets, they're actually missing 7 times the opportunities that are in the private markets. So with that, you have this, every single sector gets most of its money from the private markets, including even things like AI and data centers and the things that everybody reads about every single day, right? And they're very, very capital intensive. Now, the public markets obviously do fund some of the bigger major projects like an Amazon or a Google, but at the same, in the same vein, they're not actually raising most of their money today. They're just generating cash flow that they're reinvesting, or they're borrowing it in the debt markets in order to be able to deploy it. In the private markets, almost all of that is coming from investors who are investing in that capital in the form of equity, ownership, or in the form of loans that would be referred to as private credit, which just means credit that doesn't trade every day. So public credit, private credit. So defense gets most of its money, generally speaking, from what's happening in the private world. You have things in certainly data centers, AI, infrastructure, dams and bridges and roads and things of that nature are mostly funded from the private sector. So it's a critical piece of the overall economy, and there's always going to be a place for public, and there's always going to be a place for private. And over time, what we're seeing in the industry is they're converging a little bit more. And so imagine that your audience is now able to own a piece of SpaceX, the Houston Astros, Los Angeles Dodgers, and all of these other fantastic, really interesting assets, all with quarterly liquidity. And they can invest every single day. That didn't exist literally until 5 months ago. And new vehicles are being created to enable them to be able to do that, whether it be ours or someone else. People have the ability to now invest in a way they've never been able to invest before.
And do you get a pause by some of the recent headlines with subprime auto leasing, some of the cockroach?
Who's moo? So yes, and actually I had a conversation with our entire capital formation team yesterday and our investment team yesterday about, we are very concerned about the economy, and we're very concerned about valuations in the public markets. And every single person can go read our quarterly letter. We put it out on our website. It's available to anybody who wants to go read it. I got to tell you, it's a little terrifying putting out a quarterly letter that every single person in the world can access, and having 25 years of them. You can see where we were very right and we were maybe a little early in some things, otherwise known as wrong on some things. We're more right than wrong, but you can go read them, and we encourage you to do that because you can see the psychology of, like, in the middle of the bear market of 2002, or during the global financial crisis, when we put out the buying opportunity of our generation memo to all investors, or what was going on during the tech bubble, during the SPAC bubble of 2021, et cetera. So what I'll say is that there are definitive concerns we have with the economy. And in that letter, we talk about how there's a lot of stress on the consumer. There's an entire section that we dedicated to what we called the hollowing out of the American workforce. And it's true worldwide, but specifically we're saying it first in the United States, to where skilled labor, if you will, is not being replaced yet, and higher end corporate executive roles are not being replaced yet, but a lot of this middle is beginning to be replaced, and it's going to accelerate, and it's going to accelerate at a very fast rate.
We say
Absolutely. So what we always say is that AI won't replace people, but people who use AI will replace people. And so you look at UPS, you look at Amazon, you look at Paramount, you look at Walmart, I can go name after name after name that have laid off thousands of people in just the last 90 days. And the reason is that there was probably a little too much hiring that happened in 2021, 22. Money was easy. It was hard to find good people. And so people were like, if I can find them, I'm going to hire them. And now they're like, I don't really need all these people. And oh, by the way, one person is now doing the equivalent of about 1.3 or 1.4 what I had before. And we don't need all these folks. That's almost all in the middle. It's not really here. Now, at some point, the robots may come for that. And that is a concern that we also have when we look far out in the crystal ball, if you will. The senior executives, generally speaking, still got to make sure everything runs together. But it's this really weird, like, how do you take, if there's no middle, how do you elevate up, right? And is that going to all get replaced by AI? And I don't think so. But that's nobody's sure. But so when we think about that, subprime motor auto loans, are definitely the worst they've been since 2010. Credit card delinquencies are as bad as they've been since 2010. There are definitively cockroaches in some of the portfolios. I agree with Mr. Diamond's, statement in that regard. At the same time, I think that it's a manageable amount. There are certain firms in the world of private credit that have been too aggressive with their lending and not had good enough covenants in their loan documents. Those people are going to get hurt, and the investors in those situations are going to get hurt. But the vast majority of lenders are not in that camp. So unless you see a real, true global slowdown that takes earnings and shoots them in the foot, right? That obviously could hurt any lender, whether they had good standards or bad standards. It's going to affect everybody. What does concern me more than anything else is a lot of the consumer-related loans because of those challenges with the consumer. We in one of our letters last year, or earlier this year, actually, second quarter letter, if I remember correctly, we talked about how buy now, pay later has become such a big deal. Well, of the people that have used buy now, pay later in the last 12 months at the date of that letter, 50% of them have bought groceries with buy now, pay later. Folks, if you consume it, you should pay for it then, not later, because that's just adding up debt that is going to ultimately really come back to bite you.
Yeah, so it almost seems that when you're in an environment where there's a lot of supply and people sort of are starting to chase opportunities, maybe you get a little bit sloppy or you get a little loose on your underwriting standards and you start underwriting cost of capital versus underwriting the actual risk. And maybe we saw some of that.
There's no question this is true, of course, going back forever, right? I mean, every economic cycle that we've ever had, and I use, a phrase internally, we never say never, never say always. I using the term ever here because every economic cycle that we've ever had has some things that are in common. That's the old saying is that history doesn't repeat itself, but it often rhymes. Well, in every economic cycle that we've ever had, you have situations to where there's too much, supply chasing not enough demand, causing prices to go up, which causes people to think that they're bulletproof. And then ultimately they make bad decisions. And then, to quote Mr. Buffett again, the tide goes out and you realize that who's wearing a bathing suit and who's not. Well, that is true with every economic cycle. This one will not be different. Anytime somebody ever tells you it'll be different this time, run, don't walk away. Because it's always different, but it's never the, it doesn't matter anymore. Valuations don't matter. It can always just grow to the sky. That's just, run, don't walk. But when we look at where we are in the cycle today, there are definitively some people that got a little bit lax, that got a little bit careless, but there's not what I would consider to be rampant, silliness. When we saw the SPAC bubble in 2021, we saw a lot of silliness there. I mean, people were paying absurd amounts of money simply because of the fact that, the stock was going up. And then you had the Reddit board activity and all those other things that just really fed on itself, which created this bubble. In 1999, again, in my article, in our quarterly letter that we just wrote, I compare NVIDIA to Cisco Systems. NVIDIA is an amazing company, great company, but you can have great companies that are bad stocks. Just like Cisco Systems in 1999, March of 2000, it was trading with a $550 billion valuation. The company literally was trading at 100 times cash flow. And everybody thought it's just going to continue to grow forever because you can't do the internet without Cisco. Well, the company is much bigger now. It has grown tremendously, and it's an amazing business, an amazing company. The stock literally still is not higher than it was in March of 2020. So March of 2000. So, NVIDIA at a $5 trillion valuation, literally great company, but it was worth more, and it's gone down quite a bit since that letter was written. But at that time, its market cap was worth more than the gross domestic product of Germany, the gross domestic product of the United Kingdom, of like lots of stock markets in total. To give you an idea on the GDP, the only countries in the world doing more than $5 trillion of GDP a year is China and the United States. And that's it. One company was worth more than the entire output of every country other than China and the United States. That's a little bit extreme. Does it mean it can't go up? No, that doesn't mean it can't go up. The market can be irrational longer than you can stay liquid. So I'm not saying go short NVIDIA. What I am saying is that you have to be realistic about it. There's been several articles here from some of our fellow folks in Wall Street that talk about how at this valuation that we've been at, that the expected return over the next 10 years for the S&P 500 is literally between 0 and 3%. Howard Marks came out and said something. Goldman Sachs came out and said something. And if people think they can just buy the S&P and forget about it, I'll remind them that from 1999 to 2019, you made no money in the S&P 500. It went flat for a decade, and you had these massive roller coasters that you had to deal with over that decade. That is something that we want people to avoid. Doesn't mean you don't own the S&P. It just means it has to be sized correctly in your portfolio, and you need to own a lot of other alternatives to that and things that don't correlate with the S&P.
So the way some of it's not really tied to fundamentals, as you said, it's more tied to just the voting of the market. Just a few more questions. I know we have very limited time. On GP stakes, are we calling it GP stakes, or have we moved on to, which I think you and Michael were using?
GP Growth Capital. So I think it should have always been GP Growth Capital. Michael agrees with me on that, but it's become pretty well known to call it GP Stakes, and so we'll stay with that term today.
Okay, and then if there's sort of any takeaway that you want to impart, and maybe whether it's in relation to someone who is looking to start investing but doesn't really know how, or is still trying to kind of find their why. Maybe they think that they know what they should be doing, or they've been told what they should be doing. Maybe it's their community, maybe it's their parents, maybe it's their friends. So kind of what guys we do with those.
So a couple of different parts there. So the entire concept of what we've talked about, the growth of the private markets, the growth of alternatives. The reason why we like GP Stakes so much is because of the fact that the people that are going to be managing all of that money are going to obviously do really well. They're going to get good management fee income, and they're also going to get what's called carried interest, which is just a share of the profits that they create for people, and their businesses should grow up in value pretty significantly. So we love GP Stakes as an asset class. It's one of the reasons why it's our largest theme currently, and certainly we encourage investors to consider it because of the second part of your question, which is a lot of people don't know where to start in the world of alternatives. When you buy a GP stake, you actually get the opportunity to own a piece of the firm that manages their funds. Well, obviously, that means you're getting a piece of every fund they currently have that exists, every firm that they're doing right now or putting in place, and every fund they ever do in the future in a classic true GP stake. Well, that means you're going to participate in everything they do, which means you're going to get diversification across. If you own multiple GP stakes, you get geography diversification. You get capitalization diversification. You get size of the sponsor of who it is, the small firm managing the money, big firm managing the money. Do they invest in small companies? Do they invest in large companies? You also get diversification of vintage. So, if you have everything that's coming out in 2025, it may be a great vintage. It may be a terrible vintage. For anybody that's a wine expert, you know exactly what I'm talking about. Some vintages are better than others, some years. Well, you also get sector diversification because somebody might be a healthcare specialist. Another firm might be a technology specialist. Another firm may be a consumer specialist. Another firm may only do professional sports. Well, if you own different firms that do all of those things, you're getting exposure and diversification across all of what they do, but you're getting paid the management fees. And hear me on this one. You're getting paid the management fees. You're not the one paying the management fees like you would if you're just a fund investor. You're getting paid the management fees, and you're getting paid the share of the profits and the growth of the enterprise value. So there's just this enormous, what we call cross-cycle diversification, and also diversification across really every other manner that somebody can do it, which makes GP Stakes a great place for somebody to start because they get so much of the entire alts universe in one single investment.
So basically, they kind of become the manager, so to speak. Put your estimate is aligned with the manager.
That's correct. And you're shoulder to shoulder with the people that are the managers. Going back to the point of being freakish about alignment, that's something that we like. And so, obviously we're really well known for what we do in the world of GP stakes. And so anybody that wants to learn more about that, they can obviously go to our website and do that. Or we got a lot of other stuff, just white papers and educational material on LinkedIn, et cetera. But so, to the other part of your question. So GP stakes is a great place to start, but it goes back to, the real main benefit that knowledge brings. You have to learn what it is you're investing in. Take the time, study the basics. One of the reasons we wrote the book was to be a resource for people. Okay. And yes, we'd love it if everybody goes out and buys the book. But the point of writing the book was to be a single place where you can learn about private credit and learn about professional sports and learn about private equity and learn about venture capital and learn about energy and learn about real estate, all in one place. And then have interviews with some of the very best people in the entire world that have become really, really good in performing well for investors in that space. So then they understand their perspective. And also there's a lot of great things about building a business. We talk about their origin stories, going back to your original questions of, why did they choose to start their firm? What was their background? How did they get their first break? Those kinds of things. And we just think it's obviously the world agreed because it did very well. It's doing very well, is that people enjoy it. And so I'm really proud of that. But so that's a great way to do it, but don't stop there. There's so many great books out there, some of which we reference actually in our book, that people should go read to become more educated. Certainly use AI to be able to become more knowledgeable on the subject. Just be careful because, we all know AI is a wonderful tool, but it can be wrong at times. So just be careful and verify. But then from there, talk to people that are true experts, that are in the trenches every day, that understand what it is to fight the war, and to ultimately go through cycles. It's one of the other things that that I tell people is that if somebody has not been through the refiner's fire, then you don't know how they're going to respond when they get, what's the old saying from Mr. Tyson? Mike Tyson says, everybody has a plan until they get punched in the mouth. Okay. Well, that's true for every investor everywhere. So you got to know that they've been punched in the mouth and they've been able to come back and survive to fight another day. And then from the last part of your question, which is for somebody that's trying to figure out what their why is, don't do something because somebody has expectations of you. Be yourself, identify what it is that you love to do. I mean, just love to do, and then go figure out how to get paid to do that. The vast majority of people go through life and they never actually do what they enjoy. They do what they're expected to do or what they're supposed to do. Well, if somebody got an education degree, well, then they must be a teacher. Well, that may be the best place for them, but it may not be. Just because they have the degree doesn't mean they can't go back and get a different degree, or they can't be an entrepreneur in education instead of being in the classroom. And maybe the best place for them is in the classroom, and we need a lot more great teachers. So I hope they'll do that. But if somebody goes through and analyzes what do they really love to do every day, and what we ask everybody that applies here is, if money was no object, and literally you could do anything you want to do every single day, how would you spend your time and what would your impact be that you would do with that money? And most people don't have an answer for that. Find the answer. But then again, it's understandable because that's like pie in the sky. And I don't know if I'll ever do that, but find the answer to that. Because once somebody has found an answer to that question, everything else starts to become really clear. Tony says, where focus goes, energy flows. It's so true. The mind will find what it's looking for, and you just have to set your mind on what it is that you believe. And again, you can always reroute and reposition. But if you don't aim for anything, you will absolutely hit nothing.
Yeah.
And that is what, unfortunately, most people do when they go through life, or they come out of a good school and they go, well, I'm just supposed to go be an analyst, or I'm supposed to be, an associate on a banking desk or a private equity firm. All those are great paths, and they're going to learn a ton. But make sure you actually want to do it every day. Because if you don't, it's going to suck. So you have to have passion about it. And you have to find something that you really enjoy. That's the only way you'll give it energy. That's the only way you'll give it effort. And most of the time, if you have any natural skill and you give it a lot of energy and effort, you're going to be pretty good at it, which means you're going to win. And that ultimately is what the name of the game is to go through life winning.
Well, you really shine through. I want to say, in watching your the Holy Grail of Investing series, one thing that I really took from it was that you see some of these people have a tendency to think like, oh, these are Superman, these are otherworldly folks. I think watching, you're kind of speaking with these people, getting their backgrounds, so you realize anybody can do this if you just really, put your mind to it. I think, and have that driver. I think it's really for anybody to go after.
No, totally 100% true. And the thing about almost all people is they can do a lot more than they think they can. And they just need to be given the opportunity in their own mind and then create the opportunity in their world to go achieve what they're truly capable of. Most people can do anything they want if they set their mind to it. Going back to the thing when I was young, one of the real things that I'm grateful for is I was told early on, if you believe you can do it, you can do it. If you don't believe you can do it, you certainly can't. So decide what you want to do, decide what you want to go after, and then go give it everything you can. And usually it works out pretty well.
Christopher, thank you so much for the time.
I'm happy to. Thank you for having me. I appreciate it very much. All right.
If you enjoyed this conversation, please stay in touch by visiting our website, thebiggerwhywithsam.com. Thank you.